I found actually that small caps have this incredible power to outperform the market over long periods of time. And you get the sense it's not massively covered.
Hello and welcome to the Personal Investor Podcast. I'm Andrew Oxlade. Today, we're going to be wading into the debate on whether it's better to invest in big companies or to back the tiddlers. In recent years, it's been all about the biggest of big stocks, the magnificent seven stocks, the Metas, the Googles, etc. They powered ahead. But this year, they had a bit of a wobble in the tariff sell-off, and that's left people wondering, maybe now is the time for smaller companies to come to the fore. Or actually, have they been doing quite well already, is the big question. So I'm joined here today by Gemma Slingo. Hi, Gemma.
Hello.
Richard Evans.
Hello.
Both investment specialists with Fidelity. Gemma has focused on UK small caps in her research, and Richard has looked at the returns on AIM, the alternative investment market. And the data tells very different stories in each. But we'll start first with Gemma. What did you find in the numbers you looked at?
I found a few things, but I think the first thing to flag would be that at the moment, UK small caps are not popular. There's been 3 years, basically, of people yanking their money out of small cap funds. And there's just this general feeling that, it's not somewhere you particularly want to be if you're an investor.
And that's presumably wrapped up in the fact that everybody's seen these big stocks doing well and they want to be in the big stocks.
And it's sort of all over the news, they've delivered incredible returns. And you just get the sense, particularly in the UK, that small companies are either sort of sidelined because they're either too volatile, sort of people don't know them, or they're just a bit weird. So there's just a sort of general malaise about UK small caps, I think. But then when I was writing my piece, which is on the website, and doing some research, I found actually that small caps have this incredible power to outperform the market over long periods of time. And that's not to say they're not risky or volatile, because they are. And there have been quite extended periods where, they haven't been great. But I thought one figure really stuck with me. So basically, if you'd had £1,000, New Year's Eve, 1999, sort of millennium celebrations were happening. If you'd invested that and kept reinvesting the dividends you got from it, now you would have more money than if you put your money either in the FTSE 100 or a World Tracker Fund.
So it's even beat the World Tracker Fund.
Exactly, which is very sort of skewed towards the US, as we've spoken about before.
Yeah.
So they do sort of have the power to generate these exciting returns, and you get the sense it's not massively covered. So people don't always know. I
had a look at the chart in that piece, and it's quite remarkable, isn't it? Even sort of, if you went back a few years ago, the gap would be even bigger, as in there would be an enormous gap between not just with the FTSE, so the UK's big stocks, but also the world index would have been beaten hands down a few years ago. Obviously we've had that surge of those bigger stocks coming through in the recent years. It's a really remarkable kind of trend.
It is. And I feel like I'm biased, but it is such an interesting area of the market as well. You get some really strange companies doing some weird things, but just the growth prospects are great if you know where to look.
And is it the same? You obviously focused on the UK, but there's other research presumably, and that points to the fact that this is a trend that's repeated elsewhere.
There is. So there's this really useful body of research, which was done by a group of academics from the London Business School. And they basically created this benchmark that looks at the bottom 10% of the UK main market. And it has data stretching all the way back to 1955. So a huge database. And it found there's this small cap premium, I think they describe it as, which is essentially that small caps over time can generate bigger annualized returns than large caps. And they traced it all around the world. And I think in the past 25 years, there's only been one market, Taiwan, that hasn't sort of achieved this small cap premium. Everywhere else, you can see it. So it is seems to be a universal trend.
It reminds me of something the legendary investor Jim Slater, who me and Richard know actually from many years ago. Sadly, not with us anymore. But his quote was, "Elephants can't gallop," which always such a great kind of phrase to sum it up. So why is that? Why does the evidence suggest that smaller companies can do better?
It's a very good question. And there have been various theories put forward. I think the elephants can't gallop explanation is a good one, in the sense that if you're very small, there's more scope to grow your earnings quickly, grow your dividends, and that in turn sort of translates into share price gains. But I think there are probably other things going on as well. So in the UK in particular, small caps aren't sort of well covered. And by that, I mean, there aren't hordes of equity analysts sort of poring over their results, thinking about, consensus forecasts, where they might go. It's quite a small pool of people actually looking at these companies. And that means you can get some quite weird discrepancies between what a company is fundamentally worth and what it's valued at by the market. So if you're sort of a canny stock picker, it's a great place to be because you can find stocks and think, that looks like it's hugely undervalued, and then see a big burst in the share price when other people start to cotton on. So I think that valuation point probably plays into it as well.
Okay. Richard, let's talk about AIM. So probably the best place to start is to explain what AIM is. What's the difference between that and small caps?
Sure. So AIM is a part of the London Stock Exchange, a sort of junior market, which has been going 30 years this month.
Oh, yes, it had a birthday,
yes,
didn't it?
It did.
Yep.
Yes, a couple of weeks ago, I think.
Yeah.
And it was designed to make it easier for small young companies to grow.
Yeah.
By being able to sell their shares on the stock market and raise money. That's what stock markets are there for. But this one was different in the sense that it was there were fewer requirements on the on an AIM stock than on a stock on the main part of the exchange. Looser regulation, fewer requirements such as how long you had to have been in existence and providing accounts.
And isn't there some wonderful tax break as well? There's the inheritance tax thing, isn't there?
There is indeed.
I say wonderful. Explain that to us a bit more about how wonderful that actually is.
So another thing to try and encourage investors to put their money into AIM stocks was to make them potentially exempt from inheritance tax, which at the moment, of course, is 40%. So that is a very big incentive. There were a couple of requirements. It had to be a particular kind of stock. I'd say the majority would generally have been eligible for this tax break. The investor had to survive for 2 years after making the investment before he or she died. But then whoever they left their assets to would inherit tax-free.
Sounds like too good to be true. So,
Indeed,
the returns therefore have been great, right?
And well, I should say, of course, it's now that tax break has now been halved, so it's 20. It's now a 20% tax break instead of 40%. But yes, in a way, you're right. It was, or I would say you could say it's too good to be true because there's no point having a tax break if there are no gains to be made in the first place. And when I wrote a story recently about the 30th anniversary of AIM and ran the numbers and produced a graph for how the AIM all-share index had done. So that's every company on AIM.
Yeah.
From the beginning, from 30 years, it's actually gone down.
Gone down. Over 30 years.
And that's with dividends.
I remember seeing this chart.
Yes.
It was shocking.
And that's with dividends reinvested.
Wow. So even taking all the income paid, reinvesting that money, and you find sometimes with other markets, say with the FTSE's had long periods where it's done that, but you still make money even when it goes sideways. So that hasn't worked with AIM.
No, even reinvesting the dividends has not been enough to make a positive total return. And of course, we're talking in terms of just the index with the dividends reinvested. If you then think about 30 years worth of inflation, you've made a big loss.
Wow.
On AIM.
So why is that then? I'm sure you've got a great theory on this, Richard.
It's a good question. And I should say, of course, when I did that graph, I also, over the same period, compared the performance with an index you may not have heard of called the FTSE Fledgling, which is for very small companies perhaps roughly the same size as the ones on AIM. But so
this would be the index that's one down from the one that Gemma was looking at. So she had the small caps and this is the fledgling.
I think that's right. I think that's right. I think it's one down, yes. Yeah. But it's on the main market. So it's not AIM there. You haven't got the tax break. But that index had done incredibly well.
Oh, really?
It just up and not up and up and up. It was volatile, just as Gemma said.
Yeah.
But compared with where it started 30 years ago, a huge, huge gain.
Yeah.
So the difference was very striking indeed. So that, yes, huge gap in performance between small companies on AIM and small companies on the main market. You asked me why.
Yeah.
Very good question. I have some theories. They are theories. It's not. These aren't things you can, I think, say definitively.
Sure, yeah.
Definitively. But several things I think played into it. Firstly, AIM was the home during the dot-com boom 25 years ago. Dot-com boom and bust to a very large number of companies. So a lot of the small sort of internet startups, perhaps we remember from those years.
Sadly, I do.
Yeah, you won't, Gemma. They did seek a stock market quote, and a lot of them went to AIM, and we all know how that ended. Share prices ended up where they started, or worse. It was fun while it lasted, but investors on the whole lost almost everything across the board of British internet startups on AIM. So that was very, very bad for the market. But that's not the only thing. AIM has a very large number of oil explorers and miners. So they're small miners, they're small oil companies. And this is a risky business. These are risky businesses. Often you might have a license to drill for oil somewhere. You may have got a concession. Let's say it could be in Africa. It could be in the North Sea. But then your job is to turn that right to drill into a stream of profits. So we're talking about staying the course over making the first drilling or the first shovels in the ground, all the way to finding the resource, extracting it, selling it, and making a profit. All the while, you have to either borrow money to make that happen. It always takes years. This is a difficult thing to get right. This is a difficult thing to make money from. Some manage, the majority don't. And I think just the sheer number of miners and oil companies on AIM and the difficulty of making money in that business has dragged down the market.
Oh, okay. I mean, it's a shame, isn't it? Because this is very topical, this subject in the UK at the moment, because we're hearing a lot about this with the government's need and want to try and get capital into smaller businesses, particularly those sort of coming out of universities and based on new technology, and get the right funding into them. The AIM stuff certainly doesn't help. That story doesn't help in terms of that fundraising. But does it help the economy, do you think, Gemma, this kind of having this extra money going into small caps? As an investor, and I invest in a small caps fund or a smaller companies fund, am I helping?
I mean, I would say the government certainly thinks you are. They are very keen to get us investing just in British generally. So we've had all the rumours this year about changes to the ISA allowance. Are they going to cut cash ISAs to encourage us to invest more in the stock market? And I think the smaller end of the company spectrum is very much in the spotlight at the moment. The London Stock Exchange, published something recently basically saying we need to rebuild risk culture in the UK, and that we've moved too far into a society of savers, essentially, and we don't have the nerve to be a little bit more adventurous and see the returns that come from that. So I think there's definitely a push for more investment in the small cap universe. I mean, there's only so much power that personal investors have. So we've seen the government trying to push more money from pension funds into the UK stock market as well, because obviously they've got a huge amount of clout. But I think it's an interesting space as a personal investor. There's lots of opportunities, but it feels like there's a lot of nervousness around as well. And, if you've never looked at small caps in any depth or small cap funds, it can feel like quite a scary place to start investing.
Well, it does. Yeah, I was wondering that because I was thinking, well, actually, I don't think I hold enough small caps, especially not looking at the evidence that you guys have set out. Maybe not AIM. I've managed to avoid that one. But but it does make you wonder, doesn't it? I mean, it's individual to the person, and people do need to take financial advice if they're wondering about how to construct a portfolio and they are not sure. So they definitely need to do that. But I was just sort of wondering, in theory, with mine, I mean, if I've got a core of global tracker funds and other core funds, and I've got some active funds, and in my mix, I don't think I do have enough small cap funds. Richard, what would you suggest? Do you wish you'd invested more in small caps, looking at Gemma's evidence? And what do you think would be the right sort of allocation?
I do wish I had, actually, yes. Possibly in my age now, not that far from retirement, I wouldn't now put a very large chunk in small caps. But yes, earlier on, I think I would like to have done, not AIM, of course, as you said. And of course, everyone is different, and you have to consider your own risk appetite. You want to sleep at night, but let's say you're in your 20s, you're starting your career, you've got decades ahead of you of investment. The evidence that Gemma's mentioned is that small caps do outperform even if they're volatile. Over 50 years, over 50-year working life, 40, 50 years, you can afford to not worry too much about the volatility. And the likelihood is that small caps will do better for you than the larger stocks. So why not have perhaps a quarter of your money in small caps if you're comfortable? Yeah.
And that's the thing, isn't it? This is definitely a sort of higher risk area, I think. I mean, why is it riskier, Gemma? What's your sort of take on why that is?
Well, Richard sort of explained some of it with the very small, for example, a mining company. If you don't have profits yet, it's very hard to forecast what your growth is going to be, what your forward-looking profits are going to be, because you're not making some of the AIM stocks aren't even really making much revenue. So I think it's important to see small caps as a spectrum as well, because ultimately there are a huge number of different sizes of company, particularly on AIM, because there isn't actually a size restriction in place. So you have huge companies with these companies alongside which have, got £1 million worth of valuation. So I think it's just a case of assessing your risk appetite and doing your research, because some people love fishing around in the small cap universe because there are so many opportunities to be had if you know what you're doing. But then there are tracker funds as well if you're wanting something a bit more stress-free.
Yeah. And of course, yes, funds is a great starting point, I think, for this, in terms of if people are unsure and need guidance or help, and a fund is going to be better than trying to pick this stuff yourself. And of course, we have the Select 50 online, the Fidelity Select 50, which is funds curated, and people can use that as a starting point. And there's tons of other stuff. There's the charts you've heard about in this podcast, and they will show you those stark differences in performance. And of course, remember that past performance is no guide to the future. And that's, I think that's covered everything. Thank you very much, guys, for joining me. It's been a pleasure.
Thank you, Andrew.